We are on track to achieve this year's financial targets. And we see a number of positive proof points emerging across our businesses, with direct-to-consumer perhaps the most prominent. We have strong command and control of our DTC business. We made a meaningful turn this quarter, generating $50 million in EBITDA and adding 1.6 million new subscribers. And we feel really good about the trajectory we are on.
Warner Brothers is now expecting that division to be profitable as soon as this year. Now, that's despite concerns about streaming competition and inflation. Still, the company posted a big loss in the first quarter, and investors are looking for more from Warner Brothers. Looking for more from CEO David Zaslav. Joining us now to help digest this tough quarter is Laura Martin, Needham Company's senior media and internet analyst. Good to have you on the show here, Laura. So I want to first start with Warner Brothers Discovery there. Are you as optimistic? I mean, you have a hold on this at the moment.
Yeah, so they're making really good momentum. The cost cutting here is world class, and they keep raising the estimates of how much they can save in cost cutting. And their next focus is going to be on the film segment, which I think there's a lot of excess cost there. So I think what's happening in all these businesses is we're bringing a really disciplined cost cutting umbrella into what was traditionally in Warner Brothers under AT&T sort of monopoly cost structures, which are typically inflated.
And do you think potentially this could be something attractive that Apple could be looking at to buy?
You know, we're arguing that Apple should buy the Walt Disney Company. The issue here is I think we have a broken film content creation engine where Disney, the company, it is not broken. But here at Warner Brothers, it's unclear they can actually make like DC comic movies. So Batman has been successful. They're going to launch another Superman. So we'll see. But the Warner Brothers Film Studio has been sort of on a cold spell for the last 5 years, and Apple can't help with that. Apple's a distribution platform, so Apple would really need to buy a successful and healthy film studio to make content, not a broken one.
And so then what would be the biggest selling points in terms of the synergies that you already see between Apple and Disney?
Apple and Disney. So the great thing is the brand consistency, right? World-class brands in both cases. You'd be adding 100% omni-channel touch points because you can touch consumers in theme parks, which Apple can't do. And then you would also have 2 billion active devices in Apple. You could do some of the content of the Walt Disney Company exclusive to Apple for a certain window, 3 months or something, which would drive Apple iPhone penetrations. So there's a lot of synergies always between distribution, which is what Apple iPhones are, and content, which is what Disney is. So yeah, we think that's an interesting, but WBD does have a big library. I think it's still in the turnaround phase. We expect WBD to look at Paramount as an acquisition. You know, they reported their stock was down over 20% yesterday. And Warner Brothers is just managing the same business better than I think Paramount is. So that's the one I think Warner Brothers should buy.
So then in terms of the biggest upsides you see for Warner Brothers, especially in such a competitive streaming space here, what are your top upsides for them?
So one of the things they said that was new is that HBO churn is really high, but Discovery Plus churn is really low. And recall that Discovery Plus is all of that, let me call it super fandom content like Love It or List It or the Fixer Uppers. So I think putting those two services together should lower churn, bring more fandom, which should bring more pricing power. And you would have the upside of that really high quality HBO Max content. So it could arguably be the most powerful streaming company. We'll see. It always has held that promise and so far hasn't. But now we have it in the hands of a new CEO and a new marketing team. So maybe they'll be better. But I would say that's the biggest hidden upside value driver potential is that HBO, what they're now going to call Max, with that full line of content becomes as sticky and as popular as Disney or Netflix.
And we knew that we were going to hear a lot about ad spend coming into this earnings season for big tech. Meta, certainly surprising in that regard. How do you see the ad spend story for this earnings season in big tech?
So advertising was down like 15% for Warner Brothers in North America. So I would say the connected television ad market is weak right now, as evidenced by Roku, and Fubo just reported weak ad revenue. And this one, Warner Brothers and Paramount, weak ad revenue, down double digits. So in the connected television glass, that ad unit, those are weak. To your point, some of the Google, so Alphabet and Meta had better advertising numbers than they have. Like the momentum is turning, but that's a smartphone ad unit, so it's sort of different than. And remember, smartphone ad units sell round numbers at $2 cost per thousand, and connected television ad units sell at $20 cost per thousand. So you really have a disproportionately negative impact on advertising growth if what's weak is the connected TV ad market because of the higher cost per thousand.
And so obviously we saw a lot of money and a lot of investors pouring into big tech, despite what they were hearing from the Fed about, not pausing anytime soon. Now you have this sort of a good jobs number, although it puts the Fed in a tough space. What's your outlook for tech then, based on what we've already seen this earnings season, even though the expectation, the bar was quite low, but we kept hearing about those macroeconomic concerns still lingering?
I got to tell you, these Apple numbers yesterday were, as the biggest of the big tech, Apple's numbers were excellent yesterday. Not only did they generate $28 billion of free cash flow, but they grew on an FX adjusted, so currency neutral basis. They grew revenue at 2% out of emerging markets. They really exceeded everybody's iPhone estimates, all from emerging markets, places we never think of as having Apple relevance. So I think that's really interesting. And China's coming back. So China, it was locked down for a lot longer than the US and Europe. And now its demand is starting to come back. And it used to be 20% of total iPhone demand, and it's starting to come back. So that could actually drive sort of the upside to the Apple story for the next year or so. So I would say Apple among big tech is a good place to hide because it doesn't have any ad revenue. It just has a 2 billion active device installed base of some of the wealthiest consumers on planet Earth.
Certainly not a bad spot to be in if you're Apple. A big thank you. Always great to have you on. Laura Martin, Needham Company Senior Media Internet Analyst. Thank you and have a great weekend.